Welcome everyone to this session. We're going to cover non-current assets in this specific session. Please make sure with non-current assets, there's quite a few assets that you need to cover, and it's not just one specific standard. So we're going to go through a lot of standards, and you need to see how those link to one another. Also, before we go and continue with this, I want to talk about how to start thinking about accounting in general, but it's more applicable for me in this standards and as we progress for the rest of the standards than, for instance, with revenue. But what I normally think about when I think about accounting is that there's 5 things about accounting. So there's 5 elements. So when we go to our framework, we have an asset, a liability, income, expense, and equity. And we need to know the definitions and the recognition criteria for these items. And then we have specific standards covering each one of them. But then the specific standards go into telling me 5 things that we need to be able to do for accounting. So we need to be able to recognize and classify. So once I can meet the definition, so you will see they give us definitions. Once I meet the definition, I can classify that item as a specific asset or as equity or whatever the case might be. And then I move over to my recognition criteria. If I can recognize, I need to be able to measure. And now you need to see for assets specifically, we have initial and subsequent measurement for these items that we need to be able to account for in accounting. Then we move over to the presentation in our financial statements. On the face of the financial statement of financial position, statement of profit and loss, or the statement of change in equity. And then the last one is our disclosure, where we have notes. So each one of these standards give me guidance about these 5 things. And then we have 5 types of accounting questions that we can ask you. So we can ask you to discuss. And discussion is linked to my definition and recognition criteria most of the time. So this links to classification and recognition. Then once I can recognize, I need to be able to journalize anything in accounting, the debits and the credits. So I can journalize, but when I journalize, I need to know what the value. So now we jump to measurement. So I can ask you to journalize or calculate what initially or subsequently, any type of asset or anything that relates to an asset. And then I can ask you the presentation on the financial statements, the items where it belongs, or then the disclosure item. So I need to see that there's 5 types of questions: a discussion, journalize, calculate, present, and disclose. And I talk about this as the power of 5. So think about it when you go through each one of these standards, that there's 5 elements and then 5 things in each standard. Once we identified what it is, telling me what I need to be able to account for in totality, and then we have 5 types of questions. So let's jump into non-current assets. So I'm going to stop my video and share my screen and make sure we understand what we need to be able to follow or need to be able to do. So when we talk about non-current assets, first of all, we need to see that they want us to discuss the recognition and measurement of the non-current assets. And you will see that included there is, for instance, impairments and revaluation. And then you will see that they list quite a lot of different assets that we need to be able to do. For instance, investment property. They talk about intangible assets. They talk about borrowing cost, government grants. So there's quite a lot of chapters that is, or study, or in this chapter, there's quite a lot of standards that is covered. If we think about a schematic, and I just want you to add one item over here, and I'll talk about it once we go through it. So we need to see for non-current assets, the first one we're going to cover is, at the end of the day, property, plant, and equipment. And for property, plant, and equipment, we need to see linked to that is impairments of assets and fair value measurements, which relates to revaluation. And then we have our different other asset types that we're going to consider. So we're going to look at intangible assets. We're going to look at investment property. We're going to look at government grants. And for these items, any one of these items can link to borrowing cost. How can I recognize borrowing costs? When should it be part of my assets? When should it be capitalized? When should it be expensed? And then we go to something that's very familiar in our country, agriculture, and we will look at how to account for it. And then the last one that I want you to add to this is just to tell yourself, for these assets, if I choose to sell, we have IFRS 5, non-current assets held for sale, making sure that you know that now I need to disclose or measure it a little bit differently if my intention has changed, instead of using it, but to sell. So when we go through property, plant, and equipment, you need to understand that we will now need to cover the classification, the definition, the recognition criteria. Then we need to look at the measurement. So please spend time on this measurement and see what is all the costs that I can capitalize as part of PPE, as well as finance costs, borrowing costs. So please remember about borrowing cost, IAS 23 for in PPE specifically. And then we will talk about our measurement bases initially and subsequently. We have our cost module and revaluation module, and you need to see when we revalue, we have different methods, but revaluations all goes through OCI. And then we go and depreciate PPE. So we need to know our depreciation method, what is done by it, to be able to apply it. And then also I need to know when to de-recognize assets and what should happen if I exchange an asset. What's the rule? What value do I recognize if I have exchange an asset instead of paying cash, but I've given you a different asset for an asset that you have given me? What's the values that we're going to look at? Then we're going to go through impairments of assets and make sure that impairments for PPE, there should be a trigger for impairment. So I'm not going to measure it yearly. There should be a trigger at the end of the day for impairments, and make sure that impairments links to, you will see the scope tells us all the assets that's excluded, but you will see it links to PPE and intangible assets. So make sure that PPE, there should be a link or a trigger telling me that I need to impair. But when we go and look at those triggers, it is either external or internal, and we need to be able to recognize those items and make sure that we understand it. And then you will see that there's an annual impairment test, but that is applicable for intangible assets where they have an infinite useful life, or for goodwill. So make sure those items, regardless whether there is a trigger or an event happening, I need to test for them for impairment yearly. And then impairment, the definition, make sure that you know we talk about a recoverable amount, and that it's the higher of fair value less cost to sell or value in use. And I'm just going to link it here to the logic behind this. Remember, here we will see what a logical man will do in an arm's length transaction. So if I had an asset, but something happened to it and it will not perform as I expect, do you agree with me? I will do one of the following two things. I will either use it if I will still get more from it when I use the asset than when I sell the asset. Or I will rather sell the asset if I now can get more from the asset than when I use it. So the reason why it's the highest is a reasonable band that will get more from the asset when they sell it now than when they use it will sell that asset if it's not working as it's intended. Or if I will get more from that asset when I use it, then when I sell it now, I will rather use it. And that's the measurement behind the recoverable amount. So you can go and look at the details for value in use and the fair value less cost to sell. Also make sure that we need to be able to account for impairments for cash generating units. So then when we talk about intangible assets, at the end of the day, we need to see that intangible assets, there are specific definitions that you need to understand. You need to look at the recognition criteria, and then we need to look at measurements for these items. Please be sure or make sure that you understand that they talk about how do we treat internally generated goodwill. So when do I recognize that? And you will see they tell me I never recognize internally generated goodwill. Then they talk about internally generated intangible assets. You will see that they tell me that there's certain criteria I need to meet. And then they also talk about how do I recognize government grants that's linked, for instance, to an intangible asset, making sure that we know what's the basis. So for internally generated intangible assets, we need to see that they talk about something called research and development. And research and development, I need to understand that that's related to research phase, that is always expense, and the development phase, I can capitalize or can recognize as an asset, but I then need to meet these 6 criteria. And you will see there's a nice abbreviation, PIRATE, so there should be probable future economic benefits. I should have the intention to complete that internally generated asset. I should have the adequate resources to be able to complete it. There should be ability for me to sell it. I need to have the technical feasibility to complete that asset, and should be measured reliably the expenditures that I incur. And if I meet all 6 of these criteria, I can then capitalize it as part of intangible asset. Then important for intangible assets, We also have the cost or revaluation module, making sure that for you to follow the revaluation module for intangible assets, there needs to be an active market. And they tell you a little bit more about it. So make sure you understand the difference between the cost and revaluation module. Then we talk about amortization for intangible assets, not depreciation. So tell yourself here, depreciation is for things that's tangible, for like PPE. So intangible assets that I can't touch, I just have a paper telling me that I have a right, or I have a trademark, or whatever the case might be. That part is something that's in the air, I can't touch it, and it's amortized. So make sure that you talk about amortization here. If we move over to investment property, again, there's definitions that you need to know, the recognition and measurement. And the measurement here, you need to see that we talk about a fair value module. Important for the fair value module, if I apply it, I never depreciate. So again, the cost module applies, so make sure we understand it. And now something is triggered in this specific chapter that is different than in any other assets, because the assets that I have for investment property can also be PPE. So they can be a transfer to and from investment property from PPE. So it can be either one of the two, and we need to make sure we understand. Please also make a link here that if I choose a fair value module or cost module, it needs to apply for all these assets, and I can never change that module, unlike with IAS 16 for my investment property. Then if we go to government grants, you will see that we will talk about certain criteria that we need to meet and how do we account for government grants. Then we will also look at borrowing costs. How do I calculate borrowing costs? What can I capitalize? When is it an expense? What's the criteria that needs to be met for the borrowing cost to be capitalized as part of my asset? And then we move over to agriculture. So for agriculture, something that I think is quite new to most of you, because it's not normally covered in other syllabus, but agriculture, I need to see there's a two parts. So agriculture, the majority lies within IAS 41, where we go and talk about agricultural produce, biological assets, or biological transformation. And then the second part lies within IAS 16, where we talk about bearer plants. So when we do this, we will cover it a little bit more, but please make sure that you see that there's a link between IAS 16 and IAS 40. And then also, once I have agricultural produce that was produced, once it's harvested, after the harvest, it becomes IAS 2 infantry. So see the link with infantry here as well. We're going to look at our recognition and our measurement bases, making sure we understand it. I'm just going to share my screen again because I saw that I was kicked off with the network for a short while. So if we think about non-current assets held for sale, we will talk about the non-current assets part. You will see that discontinuous operations is also going to be there, but the non-current assets is extremely important when I now decide to sell any one of these assets. How do I classify it? How do I measure it? So we will need to go through non-current assets held for sale and see what's the approach that we follow there. But please make sure that you understand how to account for each one of these different types. Okay. And that is non-current assets held for sale and my non-current assets in totality. So please make sure, I'm just going to go and say disregard and just share my screen again for non-current assets so that we can see the link that we need to see. And I'm just going to jump to the front again. If we think about non-current assets, I need to be able to cover all these specific topics, including non-current assets held for sale. And remember, for each one of these specific standards, I need to be able to cover the 5 things. What's the definition, the recognition, measurement initially and subsequently, what's presentation and disclosure. And I really hope this video helped you to wrap your head around that. And once we go into the detail, that you will be able to see how each of these items slot into one another. Have an awesome day and keep well.